Let's get a move on and focus in on another set of corporate earnings. HDFC Life, it was a bit mixed. You had the profits down nearly 14% at 311 crores. In fact, the value of the new businesses was up nearly 25%. Their operating return on EV at about 18 versus 20%. Let's connect then with the management to talk about the financials as well as the road ahead. We've got Vibha Padalkar, who is the Managing Director and CEO HDFC Life, now joining in. Thanks so much for taking time out. Vibha, to begin with, what has been the impact of the lockdown on your earnings? Can you quantify the loss that we saw in the month of March, which is, traditionally the best month for insurance companies?
Yeah, so just to put things into context, for the month of March, we degrew by about 28%. However, the industry degrew by 50%. So in that context, our degrowth was not as much. And also, it's worth keeping in mind a couple of pockets of good news in this. One is our ticket size grew actually by 12%. And also our online channel, for example, grew by 13%. So all was not doom and gloom. Our term APE also grew by about 4%. To your question of loss, yes, certainly there was loss in the last 15 days, especially a lot of policies that required people to go and get their medical done, but obviously they could not go, was all stuck in the pipeline. So our estimate is that we have lost about 500 to 600 crores of top line and another 600 crores of renewal premium. So 500 crores of new business and 600 crores of renewal premium is what we think that we might have lost.
All right, fair enough. Getting a move on then, we have seen that the value of new businesses, that growth has been registered at about 25%. What really aided this growth? What kind of growth are you seeing for the VNB segment over the next 3 to 4 years?
Yeah, so we have said on the second question, VNB growth will be in the range of 20 to 25%, and we will continue to be an industry leader in terms of new business margin. In terms of your question on value of new business, it was a combination of product mix that gave us a fairly decent amount of jump. Almost as high as 1.4%. So if I were to look at between last year and this year, FY19 versus FY20, FY19 value of new business or NBM was 24.6, and we ended at 25.9. So 130 basis points, of which 1.4% was just a product mix. There was also an expense saving that added 0.5%, offset by some change in assumptions to strengthen our both persistency and mortality assumptions. And we ended at new business margin of 25.9.
Right. Vibha, when it comes to the non-par savings though, that's seen an increase in the total product mix as we understand, while protection still remains your focus area. How has the performance across the various segments been, and how is it that you see a product mix going forward?
Yeah, so the percentage that you mentioned of 41% is for the full year. But if you were to look at quarter four, and this is something that I have been communicating to all of you, that we will steadily bring down the non-par savings. And standalone quarter four, if you look at, unit linked is about 26%, non-par savings is another 26%, participating products 34%, term has increased from 8% to 10%, and annuity has held on at 4%. So you'll see a fairly distinct growth in the share of term.
Right. Vibha, but the persistency ratio for 13th as well as the 61st month has shown improvement on a year-on-year basis, as our stats indicate. Given that customers currently want to conserve cash, do you see these ratios actually dropping going forward, and the trends that you're seeing going forward?
Yeah, so you're right to say that our persistency right now has been increasing quite significantly. So to give you some numbers, from 84% to 88% over last year versus FY20. And 61st has also improved from 51% to 54%. But you're right, because people are conserving cash. What we don't know as of now is that the moratorium or the additional time period that has been given by the regulator for people to pay their premiums by another 30 days, whether people at the end of it will pay or whether they will stop paying. I think it will be a function of how prolonged is this pain caused by COVID. And so we'll have to wait and see. In the meantime, we are reaching out to our customers and explaining to them why in times like this it is even more important that they should pay their premiums. So, but we are anticipating some softness in people paying their premiums, and so we have tightened some of our persistency assumptions.
But what about your investment portfolio? How is that fared? And, as we understand, you've made a provision of about 375 odd crore rupees in the fourth quarter. Can you update us on the same?
Yeah, sure. So this is because of the sharp movement in equity markets and also in some of our debt portfolio. So it's completely a market-linked aspect, except for the Yes Bank 81 bonds of 106 crores. The thing is that most of this is in the participating or in some of the other policyholder segments. So no direct impact on the bottom line. But in line with our impairment policy, we have currently impaired those assets and mark to market them.
Right, now taking into account the current scenario, have you revised your growth estimates for FY21? Do you expect that we could see, the business take a bit of a hit post COVID-19?
We expect, for us, we've always been ahead of the curve. And so as long as we can ramp up and really effectively sell as well as service end-to-end online, we should be in a position to be able to catch the demand as it starts coming back. Also, we are working on product innovation, and we are known for product innovation. So that too, when customer appetite rebounds, we should be able to expand our offerings and go back to customers with a new proposition. In fact, some of the other locations also that have undergone some of the virus situations, whether it's SARS or some of the others, insurance has rebounded quite a bit.
And Vibha, how do you see the distribution channel now shaping up? Do you think that we will see the share of the digital platform rising, given now that we're going to be moving into a world of social distancing and that's going to be the new norm?
Yeah, I think digital will become a very important part of why insurance, but also everything we do, whether it's watching movies, whether it's ordering groceries and everything in between. So yes, it is here to stay. Exactly like after Demon, people started becoming more and more comfortable paying through the likes of Paytm, for example.
Right. Vibha, you were also looking to raise about 600 crore rupees via NCDs. Is this fundraising mainly to shore up your solvency ratios? Could you share the exact purpose of the same?
Yeah, it's nothing specific. It's more an enabling provision because do we require solvency today? No, we don't. We are in a comfortable situation. But it is not entirely inconceivable that in some parts of India, lockdown is lifted and so there is demand, but the volatility in the equity market still continues, which will continue to impact solvency. So it could be in a very peculiar circumstances with impact on one side, but positive news on the other side. So when that, and if that happens, we don't want to be caught out as a constraint because we are somewhat close to the wire on solvency. We want it to be completely for us to be in a position to catch that demand, and we thought it'll be good to. Right now, it's only an enabling provision. We still have to apply our mind in terms of when, what, how much, and so on.
Vibha, great to have you on the show. Thanks so much for taking the time out and speaking and highlighting on every aspect as to how business changes for you and around you, given the COVID-19 pandemic. That's the view then coming in from Vibha Padalkar.